Most people think the economy is a scoreboard, but it behaves more like a tide, and if you don't know what pulls the tide in and out, you end up blaming the waves. Welcome back to the Passive Path. Today we're talking about debt, inflation, and the credit cycle, not as headlines, but as mechanics. And to do that, I'm talking with a fictional guest who represents a set of ideas I've been hearing a lot lately. No credentials, no brand, just a voice for the framework. Thanks for joining.
Glad to be here. And I like the framing you used, because people argue about politics, personalities, and predictions. But a lot of what they feel day to day comes down to a few repeatable levers: credit, interest rates, inflation, and the way money flows through assets.
Let's start with the emotional part that people don't say out loud. Why does it feel like the game is rigged?
Because the rules reward ownership more than effort. If your main asset is your salary, you feel inflation as punishment. If your main assets are things that reprice with inflation, you feel inflation as cover. So two people can live in the same city and experience two different realities.
Give me a concrete example.
Think about two neighbors. One rents and saves in cash. The other owns a home with a fixed-rate mortgage and also owns a broad index fund. Inflation rises, groceries cost more for both, but the homeowner's mortgage payment stays the same, while rents tend to drift up, and their assets may reprice upward over time. So they're hurt at the store but helped on their balance sheet.
So the pain is real but uneven.
Exactly, and when pain is uneven, people invent stories to explain the gap. Sometimes those stories are useful. Sometimes they become conspiratorial and unhelpful.
Let's be careful here. When people say someone is doing this to us, what's the clean version of that thought?
The clean version is incentives. The system is built on credit. Credit expansion makes activity look like growth. And when credit contracts, it looks like failure. Institutions that control or price credit have a structural advantage. Not because they're magical, because they sit closest to the spigot.
Okay, I want to translate that into something listeners can use. What are the few variables that explain most of what people argue about?
I'd pick 5. 1 is interest rates. 2 is credit availability, meaning how easy it is to borrow. 3 is inflation, the speed that prices rise. 4 is asset prices, like housing and stocks. 5 is wages, which often lag. When you watch those together, you can understand a lot of mysteries.
And your claim is that these move in cycles.
Yes, not perfectly, not on a schedule, but the pattern repeats. Cheap credit leads to borrowing. Borrowing pushes spending and investment. That pushes asset prices. Then inflation or instability rises. Rates rise or lending tightens. And then the party gets smaller.
Let's map the cycle in plain language. What are the stages?
I like 4 stages: recovery, expansion, tightening, and stress. Sometimes crisis. In recovery, everyone is cautious. Bad memories are fresh. Money is slowly getting easier, but confidence is low. In expansion, confidence returns. Credit gets easier. Prices of assets climb. In tightening, the cost of money rises, or credit standards get stricter. And in stress, something breaks. Defaults rise. Liquidity disappears. People rush to safety.
That's the macro view. Where does the banks always win feeling fit?
Banks don't always win, but the structure protects them more than it protects individuals. They lend against collateral. They price risk. They can change terms for new borrowers as conditions shift. And importantly, they get paid in multiple ways: interest, fees, spread, and sometimes ownership or influence over assets when borrowers fail.
So if someone borrows badly, the lender can end up with the house.
Right. If you borrow against an asset and can't pay, the asset becomes the backstop. That's not sinister. That's what collateral means. But when millions of people do it at the same time, it becomes a social story.
Let's talk about housing, because people don't experience inflation in theory. They experience I can't buy a home.
Housing is where 3 forces collide: credit availability, interest rates, and the role of housing as both shelter and investment. When rates are low, a given monthly payment supports a larger loan. That bidding power pushes prices, so prices can rise faster than wages. Then people say housing is scarce. Sometimes it is, but sometimes it's also just credit math.
Explain that credit math like I'm half asleep.
Sure. If you can afford $1,500 a month and rates are low, you borrow more. If rates rise, that same $1,500 supports a smaller loan. So either prices fall or buyers disappear, or both. That's why rates can cool housing without any dramatic change in population.
And yet we see places where there are empty units and prices still feel high.
Because markets don't clear instantly, sellers resist lowering prices. Investors can hold property, and policy can cushion the fall. Also, empty doesn't always mean available. Some units are held as stores of value. Some are tied up in legal or financial structures. Some are simply waiting for better conditions.
So housing can act like a savings account for people with capital.
Yes, and that's why inflation often pushes money into property. People want something that doesn't melt like cash.
Now let's connect this to stocks. The transcript we're building from talks a lot about pumping and dumping. How do we handle that without turning this into a paranoia episode?
We separate two things. One is market manipulation, which does exist in various forms. The other is normal cycle behavior, which can look like manipulation if you don't know the mechanics. In expansions, narratives get optimistic. Capital is plentiful. Valuations stretch. Some companies raise money with more story than substance. That's not new. It's a feature of risk-taking in easy money periods.
So story stocks thrive when money is cheap.
Exactly. When borrowing is easy and investors are hungry for growth, the future gets priced aggressively. Then when tightening hits, the future gets discounted harder, and companies that depended on cheap funding suddenly look fragile.
What about the idea that institutions profit both ways?
Some do. If you're a market maker, you can earn spreads in many conditions. If you're a lender, you can earn interest in good times and claim collateral in bad times. If you're an investor with liquidity, downturns can be a buying opportunity. So yes, having capital and access changes the game.
That's the tension. Regular people feel like they're always late.
And often, they are. Because they are responding to headlines. Headlines tend to peak when the trend is already mature.
Let's make that practical. What does late look like in a normal person's life?
Late looks like this. You avoided stocks for years because you felt uncertain. Then after a long rally, everyone around you is making money. You finally buy near the top because it feels safe now. Then the cycle turns. You sell near the bottom because it feels dangerous now. That's not a character flaw. It's human. But the system rewards the opposite behavior.
So how do we behave opposite to the crowd without becoming weird?
You don't need to predict. You need rules. And you need to define what you're optimizing. The goal isn't to win every year. The goal is to not get forced into bad decisions.
Forced is doing a lot of work there. What forces people?
Leverage, lack of liquidity, and fragile income. If you have high debt payments, no emergency fund, and a job tied to the same cycle, you're vulnerable. When stress hits, you sell assets at the worst time, or you take on expensive debt, or both.
So the first defense is not a stock pick. It's a personal balance sheet.
Yes, it's boring, but boring is powerful. When you're stable, you can wait. When you can wait, you can choose.
Let's talk about inflation as the villain. The transcript makes inflation sound like the main tool that quietly steals. Is that fair?
Inflation can function like a quiet tax, especially on cash savings. If your money sits still while prices rise, your purchasing power shrinks. But it's also a release valve. Governments carry debts. Societies resist explicit austerity. Inflation is politically easier than overt cuts, so it shows up again and again in history.
So even if nobody is plotting, inflation is a convenient outcome.
Right, and it's predictable in one sense. If you expand money and credit faster than real production grows, prices tend to rise over time. The exact timing is messy, but the direction is not mysterious.
Okay, now I want the flow idea. In the transcript, there's this theme that money flows into one place, pushes it up, then flows out, crashes it. Give me the sane version.
Money is like water. It goes where returns look attractive relative to risk, and it goes where credit makes it easy to pile in. When rates are low, borrowing to buy assets becomes tempting. So flows go into stocks, housing, speculative areas. When rates rise, safe returns become more competitive. Flows shift into cash-like instruments, bonds, defensive assets. So yes, flows rotate, not because someone flips a single switch, but because the incentives change.
If you wanted a normal person to track the tide, what would you have them watch?
I'd give them a short dashboard. 1. Central bank policy rate trends, up or down. 2. Mortgage rates, because housing is sensitive. 3. Bank lending standards, even headlines about tightening credit. 4. Unemployment trend, not the number, the direction. 5. Inflation trend, again direction. You don't need perfect data. You need to know if conditions are getting easier or tighter.
So we're not forecasting next month. We're identifying the regime.
Exactly. Are we in easy money or tight money? Are we in expanding credit or contracting credit? That alone explains a lot.
Let's address a provocative line from the transcript. It basically says the assets they want are your house, your land, your time, your labor. How do you translate that into something helpful instead of depressing?
I'd reframe it as what is truly scarce. Time is scarce. Attention is scarce. Productive skill is scarce. And quality assets are scarce in the sense that they're limited and desirable. So the game is always about who controls scarce things. If you don't own scarce things, you trade your time. That's not shameful, but it's the baseline reality.
So the passive path version is own productive assets and protect your time.
Yes, and productive assets can start small. It can be a cash buffer, a retirement account, a side skill that earns. Even reducing high-interest debt is a form of return.
I want to go deeper on debt. Debt is framed as a trap, but debt is also how people buy homes or build businesses. What's the distinction?
The distinction is whether debt increases your options or reduces them, and whether the debt is matched to a stable, predictable cash flow. A fixed-rate mortgage that you can easily afford is different from variable debt that stretches you. A business loan tied to real demand is different from borrowing to speculate. Debt is a tool, but it has a carrying cost, and it adds fragility.
So the wrong kind of debt makes you a forced seller.
Yes, forced selling is the real enemy. When the cycle turns, you want to be the person who can hold, not the person who must liquidate.
Let's connect this to the stages again. If someone is listening and thinking, where are we right now? What do they do with that?
First, they accept they can't know perfectly. Second, they build a plan that works across regimes. Here's a simple approach. In expansion, be careful with leverage and hype. In tightening, increase resilience, cash flow, liquidity. In stress, focus on survival and selective opportunity. In recovery, rebuild positions and habits.
So the action changes, but the philosophy is constant.
Yes. The philosophy is, do not let the cycle dictate your life. Let your life dictate how you interact with the cycle.
I like that. Now, the transcript also talks about media narratives. Everything is fine until suddenly it isn't. How do we talk about that without sounding cynical?
We can be realistic. Media follows attention. It amplifies extremes, and it often reflects what's already happening rather than what's about to happen. So it's not that media lies. It's that media is a lagging indicator. If you treat it as a leading indicator, you will be late.
So we should use it as a sentiment gauge, not a compass.
Exactly. When everyone is euphoric, risk is higher. When everyone is hopeless, opportunity may be higher. Not always, but it's a useful filter.
Let's go back to the stock market example that shows up in the transcript. A company is hyped. It raises money, retail piles in, then insiders cash out. That story is real sometimes. How does a listener protect themselves?
By shifting from stories to structures. If you buy something, ask, what cash flow supports this? What downside can I tolerate? Am I buying because I understand it or because I'm afraid to miss out? Also, position sizing matters. If a single position can wreck you, you're not investing, you're gambling.
That's a strong line, but it's fair.
And it's compassionate, actually, because it tells you the solution isn't secret information. It's humility and risk control.
Now, real estate. The transcript basically says, real estate is the biggest game. What's your view?
Real estate is a major transmission channel because it's leveraged, because it's socially important, and because it's used as collateral. When property rises, people feel wealthier. They borrow more. They spend more. When property falls, the reverse happens. So policymakers often care deeply about housing stability.
And that can make housing feel like it's protected.
Sometimes. But protected doesn't mean guaranteed to go up. It means declines can be managed or slowed with policy tools. Yet if affordability breaks too hard, something gives. Either prices adjust, or incomes rise, or new supply arrives, or policy changes. Usually it's a mix.
Let's talk about those policy tools. The transcript lists 3 broad levers: monetary policy, fiscal policy, and currency management. Translate that for normal people.
Monetary policy is the price and quantity of money, rates, liquidity, lending conditions. Fiscal policy is taxes and spending. Who gets money, who pays, and where investment goes. Currency management is about stability with the outside world, exchange rates, reserves, capital flows. Most people don't control these, but they can understand how these levers affect their choices.
Give me one practical implication of each.
Monetary. When rates are rising, be cautious about taking new variable rate debt. Fiscal. When governments spend heavily in certain areas, some industries benefit, some costs rise. Currency. If your income and savings are in one currency, but your future costs are tied to another, you have exposure. That could mean travel, imported goods, or assets priced globally.
So the listener's job is to manage exposure.
Yes, not to fight the system, to understand what you're connected to.
I want to address a recurring claim from the transcript. It suggests that downturns are created so assets can be bought cheap. What's the grounded way to handle that idea?
There's a kernel that is true without the dramatic framing. Downturns transfer assets from weak hands to strong hands. That is a natural outcome of leverage and liquidity differences. People with cash can buy when others must sell. So even if nobody created the downturn, the wealthy often emerge wealthier because they had optionality.
So the important lesson isn't they planned it, it's they were prepared for it.
Exactly. Preparation looks like liquidity, diversification, and low fragility. It also looks like psychological control. Not panicking, not chasing. That's the real edge.
Let's get specific. If someone is 25, renting, saving, feeling behind, what do?
They focus on 3 buckets. Bucket 1 is stability. Build an emergency fund. Reduce high-interest debt. Make your budget honest and sustainable. Bucket 2 is income power. Increase skills that raise your earning capacity. Negotiate. Switch jobs if needed. Build side income cautiously. Bucket 3 is ownership. Start small with broad diversified assets. Retirement accounts if available. Low-cost index funds. Don't wait for the perfect time. Use a consistent plan.
And if someone is 40, owns a home, has a mortgage, and is nervous about the cycle,
They audit fragility. How stable is the income? How big is the cash buffer? How much of the net worth is in one illiquid asset? Can they handle a job loss or a rate shock? They may prioritize paying down risky debt or refinancing to fixed if possible, or building liquidity. It's less about maximizing returns and more about staying unbreakable.
you keep using the word fragility. Define it cleanly.
Fragility is when small changes cause big damage. A small rate increase causes you to miss payments. A small income drop forces you to sell assets. A small expense creates panic debt. If you can't absorb shocks, you're fragile. If you can absorb shocks, you're resilient.
Now I want to bring back the anti-time and labor line, because that's the heart of it. How does a person stop selling their entire life to the cycle?
They treat time like capital. They invest it intentionally. They buy back time by reducing fixed obligations. They build skills that give them negotiating power. They create systems, not just goals, and they avoid lifestyle inflation that locks them into a treadmill.
So the quiet rebellion is living below your maximum.
Yes, it's not deprivation. It's strategic slack. Slack is what gives you choices.
Let's talk about the emotional trap. People see asset prices rising, they feel stupid for not buying earlier, then they buy. How do you break that loop?
Name the emotion. It's usually envy mixed with fear. Then install a rule. For example, I invest a fixed amount every month regardless of headlines. I keep a cash reserve. I never use leverage to chase returns. I diversify. Rules reduce the power of mood.
So the passive path approach is boring on purpose.
Yes, boring is repeatable. Repeatable is what wins over decades.
Let's do a small thought experiment. Imagine the cycle turns and we enter stress. What happens mechanically?
Mechanically, liquidity dries up. Lenders become cautious. Borrowers struggle to finance. Companies that relied on cheap funding cut costs. Layoffs can rise, people spend less. Asset prices can fall because buyers vanish or require lower prices. And the most leveraged players get hit first.
And psychologically?
People rewrite the story. In expansion, they say this is the new normal. In stress, they say it will never recover. Both are usually exaggerations.
So what should a listener do in stress?
First, protect the basics: housing stability, food, insurance, cash buffer. Second, avoid forced selling. Third, if you have capacity, you can rebalance. You buy a bit more of what got cheaper according to your plan, not because you're fearless, because you're systematic.
Now, there's a line from the transcript about understanding the cycle matters more than picking assets. I agree, but people will still ask, what should I buy? How do you answer without giving financial advice?
I answer by giving principles. Own diversified productive assets. Avoid concentration, you can't survive. Match risk to time horizon. Keep liquidity for shocks, and avoid high-interest debt that compounds against you. If you do those, the exact ticker matters less.
Let's land the plane. If you had to summarize the whole worldview in one sentence, what is it?
The economy is a credit-driven cycle that rewards resilience and ownership. So build a life that isn't forced to sell at the worst moment.
That's clean. Now I'll do the closing for the Passive Path listeners. Here's what I'm taking from this. 1. Inflation isn't just a headline. It's a force that punishes cash and rewards ownership over time. 2. Credit cycles repeat, and you don't need to predict perfectly. You need to recognize whether conditions are getting easier or tighter. 3. The real risk isn't missing out. The real risk is fragility that forces you into bad moves. 4. The practical path is boring: emergency fund, risk-aware debt, diversified ownership, and steady skill building. Any final words before we go?
Just this: if you feel behind, don't turn that into a story about destiny. Turn it into a plan about resilience. You don't need secret information. You need a structure that works across seasons. Thanks for having me.
Thanks for joining.